Okay, let's talk about long-term debt financing, which is our lesson for 18.2. Today we're going to talk about the components of a loan application as well as talking about transactions that we as a business would have to record if we were to take out long-term financing. So, first off, remember that we talked about in our last lesson that as a business continues to expand, we're going to need to make purchases for more equipment and more plant assets. We have talked about plant assets before, probably more in accounting one, and how those are assets that we use long term. They cost more money, but we do get more life out of them. Um, and the assets or other financial resources that are available to a business we refer to as capital. And so when we purchase plant assets used in the operation of a business, we call that capital expenditures. So, like we said, capital expenditures or just the need to obtain capital in general usually requires large amounts of money. So a business can obtain this capital from both internal and external sources. One of the internal sources that business can use is the portion of net income that is not paid as a dividend. So remember, dividends are paid out to stockholders from net income, and some businesses choose not to pay out dividends and instead they reinvest that money in the business itself and hopefully grow the business instead of paying out dividends. External sources for capital expenditures include borrowing money either from a bank or from a private investor, as well as selling stock. So one way that we can obtain financing is by going to a bank. It is a convenient source of external capital for businesses. Of course, we would need to complete a loan application that requests funds because, as we know, banks take a risk anytime they loan money to someone that they will not repay it, just like we do when we offer our customers the ability to pay on credit. We know that not everybody is always going to pay. And so we also have something called collateral, which is where we have assets that are pledged to the bank to guarantee repayment of our loan. So on this next slide here talks about some of the different sections that we would have to fill out for a business loan, including how are we going to use the funds, what kind of experience does our business have, um, market demand, meaning is there a proven demand for either our product or service, and then what kind of competition do we face, what do our financial projections look like, so when will the money that we're asking the bank for, when will they be able to see it be turned into profit, as well as a collateral section. So is there anything that we're going to offer the bank um, in regards to if we're unable to pay the loan? And then also our capital profile. So looking at what is the business risking in our project that we're asking money for, and does the business actually have an adequate stake? Meaning that if we were just to ask, you know, for the money and do we have enough skin in the game, so to speak, in terms of making our project successful? So those are just some questions that the bank is going to ask you to fill out. Because remember, when we're talking about applying for a business loan, we're talking about applying for probably hundreds of thousands of dollars, if not millions of dollars. So this isn't like asking for a $6,000 car loan. You know, you're asking for $500,000 to invest in the business. So essentially, when we receive a bank loan, a note payable is actually what gets signed as evidence of that debt. And note payables that are signed for revenue expenditures, and remember we talked about revenue expenditures last chapter, it's just expenditures that it's things that we spend money on that in turn are going to make money for us. They usually have terms of 12 months or less. When we have long-term notes, those are usually common when we are using to purchase plant assets. So whether it's large amounts of equipment, land, new buildings, things like that, they also are the ones that are typically going to be backed by collateral because there's some sort of an asset that we're purchasing that's going to back up the use of those funds. So if we sign a 5-year 8% note for $120,000 on April 1st, what happens is our cash goes up because that's what we are asking for, and our long-term notes payable also goes up. And I just put on here, remember that when a note payable is signed for a period greater than a year, we put it as a long-term note payable instead of just notes payable. And so it'll go in our cash receipts journal because we are receiving the cash. So it'll be long-term note payable here for credit, cash for a debit. Notice that there isn't anything about the interest right now because we don't actually record that until the interest is actually paid. So just to keep that in mind. So what happens when you take out debt from a bank is that you do have to make monthly payments to the bank. So that note agreement requires that we make payments on the first of every month or whatever your bank happens to. And remember that a portion of this payment actually goes to interest as well as to the outstanding balance. So what that looks like, and typically they'll have some sort of a schedule like this laid out for you, which shows what you're starting with. Your payment, which your monthly payment is $2,433.17. That doesn't change, but each month the amount of interest and the amount that goes to principal. And remember, principal is what actually reduces the loan. Interest is just your cost of being able to borrow these funds. So here we're going to record our August payment, which if you add these two together, they will equal your monthly payment of $2,433.17. But $767 is going to interest, and $1,600 approximately is actually reducing your debt. So here they have it broken down. We paid our monthly loan payment. So what happens is our actual long-term note payable is going down for the principal amount. This is the amount that's actually reducing our debt. Interest expense is going up with a debit for the $767.12 because we have to record the fact that not all of our $2,433 actually reduces our debt. Some goes to cash, or some goes to interest, excuse me. So then our cash goes down for the total of $2,433.17. So this again is going to go in our cash payments journal because we're paying cash. The long-term note payable and interest expense are going to go in our account titles. Long-term note payable is actually decreasing with a debit. Interest is increasing with a debit. And those two together equal our cash credit of $2,433.17. Now, another option for a business is to obtain something called a bond. And so sometimes if you go to a bank and request a really large loan, it can be difficult because maybe the bank doesn't have that much to lend. Also, they see businesses as more of a risk when we're talking about a large amount of money. So instead, what they can do is actually try to borrow money from individual investors. And so essentially a bond it's a long-term debt, but it's a long-term promise that you're going to pay a specified amount by a specified date, and you also are going to pay interest at stated intervals. So it's very similar to like a bank loan. It's just that we refer to it as a bond. They also generally have longer terms, so you can get a bond for 5, 10, or 20 years. And like I said, they also tend to have larger amounts than a notes payable is going to have. So all bonds representing the total amount of a loan we refer to as a bond issue. And typically a corporation usually sells an entire bond to a securities dealer, and all that means is like a securities dealer is essentially like a financial advisor who then sells those individual bonds to individual investors. So you might sell a bond issue for $500,000 and your securities dealer deals that out to individual investors. They could maybe buy $50,000 instead of the full 500, or they could do $100,000 instead of the full 500. So this process of selling bonds commonly is referred to as issuing bonds. So it's unlikely that you're going to find an individual investor who's going to take out the full bond issue. Instead, you're probably going to have multiple investors who are going to end up totaling your entire bond issue. So each bond actually states a face value, an interest rate, and a due date. The face value is the amount that's going to be repaid at the end of the bond term. So if you take out a $500,000 bond, that's essentially what the face value is. Then, of course, we have the interest rate that is going to be used to calculate, and we refer to that as the stated interest rate. And so the face value gets multiplied by that stated interest rate in order to calculate our periodic interest payments. Now, something different for bonds is that interest is usually paid semi-annually, so twice a year, instead of being paid monthly like a note payable. So that's one of the major differences with the bond. So it says that we issued a 20-year 6.5% $5,000 bonds for $180,000. Receipt number 766. So what happens is our cash goes up for $180,000. Our bonds payable also goes up for $180,000. And so what that looks like when we just first issue those bonds is just like it did with the note payable, except we put a bond payable in the account title. So that goes up, we receive our $180,000, and everything looks good. Pretty simple transaction for that one. But now let's talk about what happens when we have to pay back our bonds. So bonds are actually a form of securities that can be bought and sold frequently, actually. So a lot of times you hear stock as things that are bought and sold frequently, but bonds are bought and sold just as often as stocks are. Now, the sale that happens between like an investor and an investor, that doesn't have any impact on us as a corporation. We don't care who owns our bonds. All we care is that we know who has it currently so that we can pay them the proper interest payments. So when we pay interest, a corporation actually issues one check to the bank, and then the bank is in charge of divvying out the interest to all of our investors, which just makes it easier on us as a corporation that we don't have to worry about that. So on December 31st, we paid cash for a semi-annual interest on bonds of $5,850. So what happens here, or how we figured that, I should say, is that we have our face value here, that $180,000 in bonds. We had a 6.5% interest rate, and a fraction of the year. Remember, bonds are paid semi-annually. So remember that we refer to 360 instead of 365 for those 5 days that the bank is closed. And then we have the 180, which is half of that. And if you do that calculation, you wind up with your interest payment of $5,850. So interest expense goes up, cash goes down, and we're going to put that in our cash payments journal. Pretty simple. We've done that, something similar to that many times. Okay, and those are our two that we are going to talk about for 18.2. So we can go ahead and we'll do our work together next.